Okay. So the last topic here, and I think I mentioned this, um, reversing entries. Okay, this is like definitely something you can see if you work as a uh, like an accountant, or like if you work um, even with your own small business. The accounting software that we just saw, if you're using that, this would probably be the easiest way to manage your adjusting entries and your accrual accounting. Okay, so what it is, okay, it's kind of a trick. Okay, uh, what you do is you're gonna make your journal entries at the end of the period for your your adjusting entries as normal, and it would happen on December 31st. We know that our adjusting entries happen on December 31st. And so when you had a cutoff date, we saw with that accounting software, you can move one day at a time and create a balance sheet for every single day, right? But usually our financial reporting happens at the end of each period. So December 31st is an important day and an important cutoff because that's when we're going to make our financial statements. So our adjusting entries will be dated as of the last day of that period, okay? So what you'll do is you'll do your adjusting entries, and then on January 1st, the very next day in the new period, you reverse some of them. Okay, and which ones you adjust or reverse, we'll talk about. Okay, so and we'll see why this makes the accounting easier. Okay, so uh, this trick only applies to accruals, not deferrals. So what are accruals? What's the difference? Does anyone remember? Cash after. Okay, so this will be for things like interest, right? Where we had uh, interest expense was our debit, and our credit was like interest uh, payable, right? Interest payable, interest payable. In this case, the interest is getting paid after with cash, right? And we're just first recognizing it, okay? Or it could be service revenue, accounts receivable, right? Anything where the cash is going to come afterwards, we're only going to be able to use this trick of reversing entries for those, okay? Not for like deferrals where we had like prepaid insurance at the beginning of the year where the cash was already transacted, and then we're doing an adjusting entry to adjust for an expense, or like depreciation. These are all deferrals, right? So again, just to be clear, this trick is only applicable to accruals. Okay. Now, I think it's easiest to show this with an example. Okay, um, so on December 31st, we're gonna make an adjusting entry for $1,400 for payroll. Okay, so I think we should all be familiar with this type of entry. Um, after the after this adjusting entry, these are our balances as of December 31st. Okay, so we have correctly the salary expense, and we have this liability, uh, the salaries payable. Okay, so now our December 31st cutoff date, our financial statements will be totally correct, right? We have all the correct expenses. We're showing that this payable exists to our workers, and so our balance sheet is going to be correct. It's going to correctly show our liabilities and our expenses. Now the next day moves forward, okay? Um, and so let's do two different scenarios, okay? This side is without doing any reversing entries, and this is with, okay? So without the reversing entry, when we actually make the payroll, okay, half of this, so 1,200 is for the previous period, and 1,200 is for the current period, right? What is it? 1,400. Shoot. So this should be 2,800. Sorry, I got to change that. Okay, so um, So without the reversing entry, we're going to have this situation here. And I think we kind of saw it where we're going to have half of it be an expense. And again, this is January of the next year. So half of it will be an expense for that period. Half of it will be for that payable to pay it off. And we're going to pay out the full 2,800. Agreed? Everyone good with that? Okay, so then we're going to correctly have 1,400 here. We're going to have 1,400 here. So this goes to 0. And we correctly have the expenses for this period. So this is a totally legitimate way to do it. But we kind of had to remember this, right? We had to remember that we had that payable. Okay, so now let's do it with the adjusting entry. Okay, so as I said, with adjusting entries, the trick is on the very first day of the next period, we just reverse out this situation here. We just undo it. Okay, so what's going to happen? We're going to have 1,400 here. A debit to a liability. This is like something weird, okay? And we have a credit to an expense. So there is something a little off here, but it's okay. It's going to work out. We'll see this in a second. So after this reversing entry on January 1st, we're going to have this weird situation where we have $1,400 credit balance in expense, right? So we agree this is wrong, right? I mean, it's not following our standard model because expense accounts are debit normal, right? So to credit a expense account is like kind of weird, right? But we'll see how this is going to work out. And we already just clear this out. We just pay this off. So now we don't have to worry about this liability at all. It's gone. Okay? So now on January 15th, when we make the payment, we can just attribute all of it to this period. We don't have to remember that we had that payable. So we'll just do 2,800, 2,800. And so now when I do this, what's my balance? 1,400 debit, right? So now we have this, the exact same situation is here. We have $1,400 debit, and we already zeroed this out. So the payable is 0. Okay. The benefit of the reversing entry, again, doing this just on the first day of the period, is you do not have to remember about any of those accruals. You can just treat every cash transaction that happens after as if it's fully for that period. Okay, so there's less kind of having to go back and see what you did in the last period. You just treat everything, again, see, I mean, we just treated this entire payday as being in this period. And it worked out because we did that reversing entry here. Okay? So this only, again, it only works for accruals. This would not work for prepaid, depreciation. We're just doing this for when the cash is transacted after the adjusting entry. Yeah, it's again, in the accounting system, there are no such things as temporary and permanent, right? In this software I was showing you, everything is permanent account. You will just set your income statement to January 1 through December 31, right? You'll set the time period that will kind of create temporary and permanent accounts, right? But on January 31st, if this was your income statement, it would still have this as your salary expense kind of starting, so it will still work. It will still work even if you're not doing like closing entries. It will still work in that software system, because again, it's still just looking at the dates of your cutoff, right? So this is January 1st, so it will be included if you did this as your period for your income statement. Okay, so let's try this. Let's say on December 31st, you let me write this out so it's not so messy. Let's say you had to accrue, you have interest, okay, interest expense. And let's say you took out a loan. So you took a loan out on, I don't know, let's say July 1st. It is for $15,000, 7% interest, and principal and interest are due in 1 year. Okay, so let's just do an example here. Okay, we have time, so I think it's worth you guys understanding this and doing it yourself. So okay, so the first question is, what is the adjusting entry on December 31st? Okay, so this is question one. Number two, what is the reversing entry and the balances of interest expense and interest payable on January 1st? And then three, on July 1st of the next year, what is the journal entry? Okay, so try this, see if you can figure it out, and then I'll give you 5 minutes because we're running out of time, and then I'll just do it in the last 5 minutes. So um, see if you can work with this. Okay, so the adjusting entry. Okay, so the math behind this, just to be clear, it's $15,000. Okay, my interest rate is 7%. Okay, so my yearly interest is 1,050, and I counted the months for you. It's 6 months out of 12. So for half the year, I'm gonna have to accrue half of this, 50% of this, so $525. That's the expense, the interest expense that I've gone from July 1st through December 31st. Do we agree? Okay, good. So I'm gonna do interest expense, 525, and then I'm gonna have a credit. What's my credit account? Interest payable, exactly. Okay, and this is gonna be on what date? What is the date of an adjusting entry? December 31st. Okay, so now this is answer number one. Okay, now the second question is asking, okay, so now cutoff period happens. My income statement and my balance sheet for this year are going to be correct because they include this expense, includes this liability. Now moving on to the next period, I'm going to reverse this out. Okay, so January 1, the next period, I'm in a totally new period of time. I'm going to, uh, kind of my expense accounts are going to start over technically, but they're not really like in an accounting software. I'm just have a new cutoff date on January 1st. So what I'll do is just literally reverse this. Okay, I'm going to take the exact same accounts, but just undo them. Okay, and what that's going to do is now my interest expense, that's going to have 525 here. And then my interest payable, it had 525. It got debited 525. It's now zeroed out. Okay. So uh, I again have this weird thing going on here, but it's going to get fixed when I pay off the loan. Okay. So now on July 1st of the next year, so July 1 next year, okay, I'm going to have a couple of different accounts. I'm going to have number one, I'm going to pay off that note payable. Okay, I'm going to debit that. How much? What was the how much did I borrow? 15,000. Okay, so I'm going to debit that 15,000. Okay. And this is kind of the beauty of this whole system. I can just put everything, all the interest to interest expense. I don't have to worry about that adjusting entry I did before because I've already reversed it out. So what was the total interest? I think 1,050. Is that right? And then cash 16,050. Okay. And so now after I do this, what happens is uh, I have interest expense. It was 525 here, right? From this reverse, this 525. Okay, so now this period is going to show the correct amount of interest for that period of interest expense, even though in this journal entry, I just put all of it because I did that reversing entry. Okay, so it's quite a smart system. Whatever smart accountant or bookkeeper came up with this, it's quite brilliant. Okay, so that's why accountants use it. Because that's a deferral. This only works when the cash is transacted after. Depreciation is a deferral. Depreciation is when you buy the machine first, the cash transacts.